Hi, welcome to today's lesson. Uh, Today we're going to look at break-even point, and we're also going to look at past paper for this question. So, Sifa Limited manufactures and sells a single product. The following information regarding the company for the year ended 31st October 2014 is provided. So you have been given information here that relates to Sifa Limited manufacturers. So let us go through the information so that we can see what you have been asked. So in this company, sales is 15,000, but remember there are 3 zeros here. So our sales in this case is 15 million. We have direct materials 3250. We have direct labor, which is 2700. Variable overheads is 3500. Selling and distribution expenses, we have variable. Fixed selling and distribution expenses, we have 989.5. Administrative expenses is 1050. Then you are told the following changes are expected to occur during the year ending 31st October 2015. So we are expecting some changes in the company. So in short, you can see that we have the sales and these are the expenses. So we have direct materials. This one you consider it as a variable cost because material cost will change depending on the production, the material cost. We also have labor. We also call it a variable cost. We have variable overheads. Then we have selling and distribution expenses, variable and fixed, and we also have administrative expenses. When you have such kind of a question, you need to know the meaning of variable costs and the meaning of fixed costs. Remember we said that fixed costs, these are costs that do not change with changes in output. So one of it is rent. So if you produce 1,000 units, rent still remains. The rent cost will still remain. If you do not produce any unit, if you are a manufacturing company and you do not make any production in your company, the rent cost, if you're paying rent, the rent cost will still be the same. So that means that fixed costs are costs that do not change when there is any change in output or in production. But now when it comes to variable cost changes with changes in production. So that means that when in your company, if it is a manufacturing company, if you're producing 20,000 units, you'll need depending on the type of product that you're producing, maybe you'll need labor in terms of maybe 500 employees if you're producing 20,000 units. What happens when you're not producing? Maybe that day you do not have any order or you're not doing any production. It means that the labor will decrease to 0 or maybe to 2. So that means that labor is considered to be a variable cost. It changes with the level of output produced in the company. So we are being told that in this company, the following changes are expected to occur during the year ending 31st October 2015. We have variable selling and distribution expenses will reduce by 5% due to increased efficiency of the sales staff. So the variable selling and distribution expenses. So here you can see we have fixed selling and distribution expenses, and we also have selling and distribution expenses. We also have the variable. That means that these expenses are going to reduce by 5%. So it means that we need to do a calculation so that we can reduce this amount by 5%. So this amount is going to reduce by 5%, and we will see what you're supposed to do. Variable overheads will increase by 3%. So when you're told that variable overheads, so we have the variable overheads here, it's going to increase by 3%. That means that we have to do something to this value and increase this value by 3%, so that we can now have our new value for the variable overheads. So that is part 2. Part 3, labor cost will reduce by 4%. So labor costs is going to reduce by 2%. This figure must change and reduce by 2%, so that now we can know the new cost. Material cost will increase by 2% due to inflation. So that means that we will come to material cost, do a calculation, and increase this value by 2% so that we can have our new value. We are also informed about selling price. Selling price reduced by 3% in order to attract customers. So if selling price is going to reduce by 3%, here we are going to consider selling price in terms of the sales that we have. It's going to our sales are going to reduce by 3%. Then there is no stock. No stock is expected at the end of the product. Then your required expected break-even sales for the year ended 31st October 2015. So just a recap of what break-even point is. It is a point whereby the company is not making any profit and the company is not making any loss. So in business, there is a point where your expenses in terms of business expenses is 100,000 and your revenue is 100,000. Means that everything that you're going to earn in terms of revenue is going to cater for the expenses. We call that point break-even point. No profit, no loss. So you're not making any profit and you're not making any loss. So it is very important for our business to know the break-even point, so that the business can know at this point, we know that if we are able to do this sales or this number of units in terms of sales, or if we are able to make a certain amount of money in terms of sales, we will be able to cater for our expenses. But for us now to have our profit, we will need to make more sales so that we can be able to do it, to get the profit. That is why most businesses, they need to know the break-even point of the break-even sales, so that they can be able to know at what point are we able to make a profit, at what point are we able to pay our expenses conveniently, at what point are we able to know that our business is stable. So let's break down to our question. So we are supposed to calculate break-even point. When you're given such kind of a question, you're going to start with sales. The selling price will reduce by 3% in order to attract customers. So it means that we'll go to sales. Our sales here is 15,000. So for us to be able to reduce it, we are going to multiply by 97%. So it means that 100% sales is 15,000, but now our sales is going to reduce by 3%. So it means that our new sales will now be 97%. So 97% of 15,000. So 97% is the same as 0.97. So you can write 97% times 15,000 or 0.97 times 15,000. Then you're going to have the sales. So remember to write the zeros up here, because you can see that in this question we have the 3 extra zeros. So from there we're going to subtract the variable costs, all the variable costs, so that you can get what we call contribution. So sales minus variable cost is going to give us what is called contribution. So we want to get contribution so that you can be able to calculate break-even point. So variable costs, we have direct materials, direct labor, anything variable that is in this question, we are going to subtract it. So direct materials is considered as a variable cost. Direct labor is also considered as a variable cost. Variable overheads is also considered as a variable cost, but we must factor in these expected changes. So variable selling and distribution expenses will reduce by 5%. So variable selling and distribution expenses is going to reduce by 5%. But you can start with the direct materials. So you just come here, material cost will increase by 2%. So when material costs increases by 2%, we are just going to multiply the material cost that is here times 102%. So an increase of 2%, we are going to add that increase to 100%. So you want to know at 102% what is the material cost. So 102% times 3250 should give us our material cost. Direct materials is 102%, or you can, when you divide 102 divide by 100, it is going to give you 1.02 times 3250. So we'll have our direct materials as 3315. Sorry. Let's go to direct labor. Direct labor is our next variable cost. So we get the additional information about direct labor. So the labor cost is going to reduce by 4%. If labor cost is going to reduce by 4%, we're going to say 2700 times a reduction. So we consider this one as 100%. But now if we're going to reduce by 100%, so we're going to say 2700 times 100 minus 4%, which is going to give us 96. So 2700 times 96% is going to give us the direct labor. So 96% is the same as 0.96 times 2700 is going to give us our direct labor. We proceed to variable overheads. Will increase by 3%. So our new variable overheads will be 1.03. Our new variable overheads 1.03 times 3500. We get that. Then we also have anything variable. We also have variable selling and distribution expenses, which is going to reduce by 5%. That means that our 1300 should be reduced to by 5%. So 1300 times 95%, it should give us our new variable selling and distribution expenses. So 95% is the same as 0.95 times 1300, and we'll be able to get the variable cost here. So the total variable cost is 10,747. So we'll take the sales, subtract by the total variable cost for us to get the contribution. So I want us to be able to calculate profit, and then if you have a question you can always ask. So we have our contribution here, sales minus variable cost. We say that it gives us contribution. So after we get our contribution, we are going to subtract the fixed expenses. Contribution minus fixed expenses is going to give us the profit. So we come here, our fixed expenses, we have what? Fixed selling and distribution expenses, we have 989.5, and we also have administrative expenses. I think I could have written fixed administrative expenses as 1050. So those ones will not change, so there is no reduction or increase. So our total fixed expenses is 2039.5. So our profit is 1763.5. That is our profit, and that is how we are able to get our profit. Any question up to there, you are free to ask. Any question or clarification? Okay. If there is no question, we can proceed to calculate break-even point. There are several formulas that you can use to calculate break-even point. So we can just use do a recap of some of these formulas. That video lecture has been uploaded on break-even point. So in this case, we are only going to use break-even point in shillings because you have not been given the number of units in this question. So you're only going to use break-even point in shillings. So we have several formulas. We have this one, fixed cost over contribution margin ratio. How do you calculate contribution margin ratio? You take the sales minus the variable cost, divide by the sales. I think we could have used, we can use this formula and see if we can be able to get the same answer. So very fast, if you have a pen and a book, help us to calculate break-even point in shillings. So we are taking this formula, fixed cost over contribution margin ratio. So our fixed cost here will be, so what will be our fixed cost in this case? Yes, 2039.5. So you can take this and you can also multiply by 1,000. So you just take 2039.5 times 1,000. That figure, you write it as our fixed cost. Though tungeanza na contribution margin ratio, but there is no problem. So you can write contribution margin ratio is equals to sales minus variable cost over sales. So we have our sales here. Sales zetu ndo hizi 14550, unaweza ongezea 0.3 ama utakumbuka baadaye utaongezea. So you can just add 14550 minus, actually you already have contribution. So we are saying sales minus variable costs, sales minus variable costs, we will get contribution. So actually we are using this value, contribution divided by this. So you're just going to say 3803 divided by 14550. Then you say fixed costs divided by answer. What are you getting as your break-even point in shillings? If you get the answer, you can just write it in the in-call messages. Oh, we are doing management accounting. I've seen the message right now. Very fast. Tell us your break-even point in shillings. Yes, you can see 2 answers. What are you getting as your answer? Mm-hmm. 3 answers. Yes, and all of them are similar to each other. So, and I also have the same. So let's make an assumption that that is the correct answer. So that is how you calculate break-even point in shillings. So ensure that you have your answer as 78,02,977. $978 or 977.9. Yes. Expressed in percentage. So we are using this one. hii haina percentage. Yeah, it can be expressed in percentage if you are using break-even point. So we have several formulas. There's break-even. Let me show you. So we also have another formula. Break-even point per sales ratio is what I'm looking for. But I think you should be getting the same answer. This one. Let's try to use this formula, but it's the same. Contribution per sales ratio. We take the contribution. Let's use this one. See if we are going to get the same answer as the break-even point. So we are using our fixed cost. Let me go back here. So the formula that you are using is fixed cost over contribution per sales ratio. So this is the total fixed cost. Contribution per sales ratio So we just take contribution divide by sales times 100. So our contribution is this one, 3803. Remember there are 3 zeros. Divide by our sales 14,550 03 times 100. And remember to leave your answer in percentage. So what are you getting as your contribution per sales ratio? So you multiply by 100. You take the contribution, divide by sales times 100. So what is your contribution per sales ratio? I can see 26.14%. I also have the same. So let's use 26.14%. Then we come and take our fixed cost. Fixed cost is this. So 20, 39, 0.5 times 1,000 is 2,039,500. Divide by 26.14%. Because it's fixed cost, over contribution per sales ratio. So 26.14 divided by 100. So what are you getting as a break-even point? It should be the same answer as the one that you got, or maybe a very slight difference because of the percentage and the 4 significant numbers and all that. 780, I can see 78, 02, 218, 218, 219, or if you used the zeros, you should get the same answer, 78,02,977.9. So I think with that we are good, unless there is a question. Anyone with a different answer, or anyone who needs clarification on the same? Okay, if there's no question, 3803. Yes, this is the contribution. This is contribution, and this is the fixed cost. So sales, the formula is sales minus variable cost is going to give you contribution. This is the contribution. And then the total fixed cost in here hapa 2039.5 in your total fixed cost. So if you use that formula, you're supposed to get those answers. So if you have understood that concept, so there is this aspect. I won't go much on margin of safety, but for margin of safety, you just take the actual sales minus break-even point. Fixed cost is 2039.5. So there is a past paper question, an MA past paper question that I want us to look at. So management of a company are planning an aggressive advertisement campaign for their products in the period 2023 to maintain the growth pattern already experienced. The accountant consequently presented the data for the year 2022 as follows. So kuko na fixed costs. These are the fixed costs that have been presented. We have administrative, this is the amount, selling 600,000, manufacturing 380,000. Then you have what we call variable cost per unit. So hapa tumepewa in form of units. So material cost tunaambiwa ni 21 shillings for 1 unit. Haya, labor 47 shillings for 1 unit. Variable production overheads 38 for 1 unit. Then you have the selling price per unit also and you also have the sales expected within the year 20,000 units. So sales tumepewa in form of units, alafu tukaambiwa taxation. Remember that taxation we are going to use it in profit. So profit lazima tutoe ka tax ka 35%. So you're required to calculate profit before and after tax. 8 marks, hizi ni za bure kabisa. Break even point for 2022, 8 marks. Break even point when the advertisement cost is 170,000. We'll discuss this. So advertisement cost 170,000. Then profit before and after tax when sales required is 8 million and advertisement is expected. So I want us to do this question very fast, discuss it and do it, then we call it a day. I'll add you another question, but I don't know, I think that other question is similar to this one, but I'm going to confirm. It was a cut paper. So when you're given such kind of a question, of course you are using this method, this one that you have just looked at today. Of course this is what you are going to do for us to be able to calculate profit. But now the issue is, in this question we have not been given in terms, so hapa tumepewa fixed cost in terms of shillings, alafu hapa tumepewa in terms of units. So we have to convert everything here ziko in terms of shillings so that you can be able to work this question out. Because here we have been asked profit before and after tax, whatever you're going to get, we are going to use it kwa break even point and also in the others. So what do you think? What is the first step to do when you're given such kind of a question? The first step to do, we'll follow the same procedure. So where do we start? Kutafuta kutafuta sales. So let's proceed. Sales unakuja, so the sales expected within the year is 20,000. So 20,000 times 378 very fast. So tunatafuta sales in form of shillings. So usishangae what you are doing. So you're going to look for sales in form of shillings. So but tumepewa sales in form of units, alafu tumepewa selling price. So it means that for sales tutasema 20,000 times 378. Mnapata ngapi? $7.56 million. So hapa tunaweza ziweka pia na zero zote 7560,000. So you just multiplying this by this ndo tupate sales. So after sales you still follow the same format. Next step, si tumepata sales, we are going to less the variable costs. So you write less variable costs So variable cost ya kwanza ni gani kwa hii swali? Material na labor, na pia kuna his ndo variable production overheads. So tuanze na material. Lakini hii tumepewa variable cost per unit. So kupata the variable cost in shillings, what are we going to do? Yes. So 121 times 20,000 very fast. 121 times 20,000 ndo to convert ziko in shillings. Yes, 2,420,000. So you can just unaweza zipanga hivi. Kwa management accounting hatuko serious na kupanga kazi sana. Si must tuchore hizi line hadi. So unapanga tu hivi, unaandika 121 times 20,000 unaweka hapo. Tuende kwa labor hivyo mpaka tupate contribution. Hiyo ni gani? Labor. Acha tuone 47 times 20,000. You can do it mpaka ufike kwa profit. So what are you getting as your labor? Labor cost ni ngapi? 940,000. Yes, I've also had another 940. So labor is 940. Variable production overheads 38,760,000. Correct. Add them. Add the variable cost. What are you getting? Total variable cost 41,20,000. Correct. Sales minus variable cost, contribution mnapata ngapi? 34,40,000. Correct as well. So if you are not getting those figures, kindly jua umekosea mahali, rudia tu pole pole. So let's subtract the fixed costs. Fixed costs ziko wapi? Naona zindo hizi. So we will start with administrative. then selling, manufacturing, ni mulifika huko saa ngapi? Ati, what are you getting? Total fixed costs. Yes, 213,000, correct. Alafu profit. Yes. Na mko fast. Si kwa exam ikikuja mfanye hivi. What is the tax? Less tax ya 35%. Tutarudia polepole. I just want to know what you're getting as your profit after tax. Then tutarudia tu polepole. Okay, 851. Yes, 851, 500. That is the profit after tax. So profit before tax, you have it, and after tax. So I want you to calculate break-even point. Kama umemaliza, calculate break-even point so that I can continue explaining for the others. So using any formula that you know, calculate break-even point. In shillings, of course. Okay. So I want us to go back so that I can be able to explain to the others. Haya. We already have our sales. Sales tumesema we are going to take 378 times 20,000. We get our sales. So you can screenshot this so that you have a question. You can have the question. Hiyo swali, calculate break-even point. Sorry. So sales tumesema we are taking 378 times 20,000. Variable costs unachukua material itakuwa 121 times 20,000. 121 times 20,000. Labor is also a variable cost. 47 times 20,000 Then variable production overheads ni 38 times 20,000 as well. So Omar, this is the question. You just screenshot it and then you calculate the break-even point. So in short, we are just arranging our work the same way tumearrange hapa. The only difference, so tumeshapata sales, variable cost. So direct materials tumesema ni 121 times 20,000. That is what tumepata as 2420,000. Watu wamemaliza hadi break even point. Kindly, if you get your break even point, write it in the in-call messages. Then direct labor tunasema hapa tuna multiply 47 times 20,000. Because 47 ni for 1 unit, variable cost for 1 unit. Ni kama kuambiwa the cost, labor cost ya kuproduce, sema kama ni kampuni ya tissue, so 1 tissue paper. So that means that sales, kama tuna produce 20,000, variable cost ya kuproduce ama labor cost ya kuproduce 20,000 units, labor yenye tutahitaji ni 20,000. So 47 times 20,000 should give you the labor cost. So variable overheads the same, 38 times 20,000. Then now you get the total variable costs. Which is 4120. Then you take the sales minus variable costs for you to get the contribution. I can see I've already calculated the break-even point. So after getting the contribution, you subtract the fixed costs. Fixed costs kuna administrative, selling na manufacturing. Add them, then you subtract for you to be able to get profit. So is there anyone who has not understood ama hajapata contribution? So I want us to discuss this so that I can leave this question, you work on it. Break-even point when advertisement is 170,000. So break-even point, Jared, confirm if you are supposed to get 46,81,046.5. Kindly confirm, because I can see a good number. Yeah. Oh, thank you. So good work if you have that range, 46,81,046.5. So when you're told break-even point when advertisement cost is 170,000, what is advertisement cost? Is it a variable cost ama ni fixed? Ati nini? Advertisement cost is what? Yes, hata Google. Hebu jaribu tu Google advertisement costs. Is it variable cost ama ni fixed? Acha tuone Google itatuambia nini. What has Google said? Yes, Google imewaambia aje? Yes, it's a fixed cost. So what you're going to do, we want to calculate break-even point. Unaona hii 170,000. You're going to add it kwa hizi fixed costs. Hizi. So then you calculate break-even point. So utachukua 1150,000 plus 600,000 plus 380,000 plus plus 170,000. So that will be our total fixed cost. Then calculate break-even point. So you can do it and send us your workings. Profit before and after tax when sales required is 8 million and advertisement is affected. So it means that our sales now will be 8 million. So hatutatumia sales ya 7560. So unatumia sales ya 8 million and then you also use you effect the advertisement cost kwa fixed cost. Then you'll be able to work this one out. That is how you get 1625 marks. Hivyo tu. Any question here? It's on the screen. Ama juu. So let me share the question in the... Yes? Hey. Let me share the whole document kwa WhatsApp so that you can have it. Yeah, so I'll be able to share it. I can see time is not on our side. I'll also be able to share the workings for the question that you have done, but hapo tu mpaka hapo kwa profit after tax. Kindly calculate it and work on it. In case you have a question, you can always review the video lecture, or you can reach out, but you can review also. Thank you so much for your time. We are supposed to have, I don't know if on Monday we can have a 2 hours lesson so that you can be able to recover the class that we missed on Monday. Sijui kama it will work, or maybe later but we need to have extra lessons, especially sijui kama ni next week, so that you can be able to clear the syllabus. Especially for FM, we will have to wake up several days to do some extra lessons because the syllabus is a bit long, and at least by July hapo katikati we are supposed to be done with the whole syllabus, especially for financial management, because it's very long. So there is a week that you're going to set for extra lessons for financial management, so that you can be able to clear the syllabus. So kindly, when that week arrives, tujitole. So with those few remarks, thank you so much for your time. I wish you all the best. Let's meet on Monday. And I'll also send a question. Yes? Any question?